All right. What's up, everyone? Welcome to another Ask Me Anything happy hour with the BYOB Money Mentor team. We're going to be answering all your questions, so put them over in the chat box. Anything around infinite banking, about real estate investing, HELOCs, moving money, anything financial, we're here to help. We're going to do a quick introduction, and then we'll get to answering your questions, so get them over in the chat box. Be right back in 14 seconds to get rolling. All right. Welcome, everybody. Thank you for being here. We're going to be answering all your questions, so get them over in the chat box. My name's Stephen Nagy, ringleader of this motley crew, and just happy to be here. It's been a good day so far. Today, we started this morning out with What the F Happened. If you missed that, we live stream that every Wednesday as well at 9:30 a.m. So make sure you're a subscriber on the YouTube channel so you get those alerts and never miss an episode. Get caught up on the news from our point of view each and every single week. Wealth webinar was pretty cool today, talking about the markets, the economy, what's going on with jobs and interest rates, an all-time high with the stock market. Gold broke $4,000 an ounce. Unbelievable. Never thought I would see that this decade. And it happened in 2025. So pretty wild stuff. It's not normal, just so everybody knows, where gold and the stock market are both at all-time highs. So what's going to break the camel's back? We're going to get into that a little bit this show, I'm sure, as well. And I know a lot of you are traveling right now out to Denver, Colorado, to the Money Multiplier Mastermind. And the rest of you I will see in November 7th and 8th in Orlando for the Private Money Club Money Tank event. So really looking forward to that. If you don't have your tickets, make sure you grab your tickets for that. But let's do a quick around the horn with everybody, and we'll get answering your questions. So get those over in the chat box. I'll start with Shauna Decker, says she needs to hop off in about 3 minutes. So Shauna, thanks for being here.
Hello, everyone.
Like four and a half, Stephen.
Okay, we got
I am Shauna. I'm up here in New York with Joe and Chris Noggle himself, and I am a user and consumer of infinite banking. So I have all the same questions as everybody else in the chat, and I love being, enlightened every day, learning something new. I'll pass it over to Brian Fouts.
Everybody, Brian Fouts here up in Northern Idaho. Public service announcement. Always check the backgrounds if you're on camera. So I was I was on a call today. It's funny. The client goes, and the husband and wife were talking, get towards the end, and the wife goes, "Is that a Leopold?" And I'm like, she goes, "Is it hunting season where you're at?" I'm like, I had a big rifle sitting behind me right here. I'm getting ready. I'm getting everything out for hunting season, and she knew what she was looking at. And she goes, "Is that the Leopold, the scope and stuff?" And so had a fun conversation after that, but it was pretty funny.
That's impressive. She knew what it was.
Yeah, it was. Yeah, she knew it was. So, anyways, just always check the backgrounds. You never know. So
yeah,
there you go, Tess.
Oh, I'm back.
Hey, Tess.
Hey,
You're up.
I'm up. Okay. I worked inside the four walls of an insurance company for 30 years. And when I found out about this process and how amazing it is, I thought, I got to get out front because it should be shouted from the rooftops. And if you hear a noise, if you see a little fur animal come by, that would be Acro. He's been talking. And as soon as he started talking, I went frozen. So maybe he's up to something.
Hello, everyone. I'm Jason Sipple down here in the city. Beautiful. Thank you, Tess. Thank you, everyone. How's everyone doing today? Go ahead and get the questions in the chat. I don't see many questions in there yet, but we're here to answer them. We do this every Wednesday, so we're happy to be here and honored to be here and ready to serve. So over to you, Mr. HELOC.
HELOC Joe here. Let's get some questions in about infinite banking and HELOCs and real estate, so we don't have to talk amongst ourselves for the next hour. So because we want to answer questions, so get them in, so we can do some answering.
All right, Joe. Here's a quick question for you. Anna's saying, "Where has Bree disappeared to?"
Yeah.
She's around. She's with me all day long on all of our calls.
So reading between the lines, she needs a break from Joe, everyone. She needs a little break. She needs not to see his face for a few minutes. That's all. So
We did have a meeting just before this, Anna, and we did see Bree. She is still around, but I think like they said, she's Joed out for the day.
All right. And then Christian O'Mara saying, so my question is to see what your opinions would be. So if I'm trying to expand my business, equipment is needed, can't go through the SBA or bank because of credit, where would I find private lenders or investors to expand business specifically through equipment?
That's a challenging one right there, I'll be honest. When I was doing in financial education, this came up quite a bit. So the challenge is a private lender is typically not going to invest on a business because it's typically very risky and it's going to be dependent on what the collateral is. So I guess the question would be this, is that you might be able to get a private lender or someone like that, but you'd have to have some sort of collateral or some value to put up against that loan. And so that's why a lot of people go through the SBA. That's personally guaranteed though, which I would not recommend in my opinion because, well, personal experience. But yeah, I mean, if there's no guarantee, then they want to have collateral. So that's kind of my experience.
My first question, Christian, is what kind of equipment is it?
Yeah.
Could the investor buy the equipment and then have that as collateral and then you pay them back kind of thing? I guess there's,
Yeah, exactly right there.
It's something so Private Money Club, the evolution is we would like to be able to, do loans on other things outside of real estate. Right now, Private Money Club's all real estate related, but with that being said, if you're able to collateralize it or, if you're looking for, maybe somebody to bring into the business, something like that, what you can do is go into Private Money Club and start, networking and posting in the community forum, because anything really is allowed in there as long as it's legal. So you can't post this in the deal section. There's not a separate section just for equipment or trucks or trailers, but you can get to that community section and, people in there are looking for places to put their money right now because they're getting out of the stock market. They're moving it around, real estate. The right deals in real estate are good, but there's also people looking to diversify a little bit outside of real estate as well right now. So, it could be some opportunities networking with people in there. And then of course, you guys know, I'm going to say it, but in Orlando next month, come to Money Tank and, meet people because people have money and they're looking for opportunities. And so if it makes sense, there's interest, there's profit involved, there's an upside, somebody may be looking to diversify out of some of these real estate deals, and that would be huge. And if you can collateralize it, that's, that much better. So definitely check it out.
It sounds like it is the industry he's in is the semi-truck, logistics, because it looks like he's expanding for a semi-truck and trailer with guaranteed interest plus % of profits quarterly. And of course they can buy it and collateralize it, he says.
Yeah, I mean, it's like anything, you find somebody that has money that's looking to grow that money and, make the deal work between both of you, whatever that looks like. But if you if you don't have people or know people, that's what Private Money Club's all about, is that community.
Yeah. Brett Miller is saying, so when I pay myself interest on a loan, can that interest increase my cash value past my pre-loan cash value?
Well, you skipped the first sentence.
Heidi ho, all.
Heidi ho!
Heidi ho!
It's the best part of the whole question.
Yeah, I love it.
Heidi ho!
Well, on that one, I mean, it depends. I mean, you might be able to put a bit more in above your cash value if you have room for extra POAs beyond the scheduled POAs. So you just have to call us up or call up the insurance company to ask.
Keep them. You got to keep them separate buckets. So if you're paying back the loan, it's just going back and uncollateralizing your loan. So it's not going to build any additional cash value. If you're, like Brian said, if you can go over into the other bucket and add additional PUAs above and beyond, that's how you can add extra cash value. But they're two separate things. And I'm just saying that as clear as possible, because a lot of people hear Chris and talking about, hey, we're going to move the money in this circle and it's going to go out. And when you take a loan and they get policies and they think, hey, I have to take a loan so I can make more money. And the only way you're making a money is if you're making a spread on whatever you've taken the loan for, to go make a spread and have it earning you more interest than what you're paying to the insurance company. So paying it back doesn't give you more money. It just gives you the money to use again.
Right.
The other way you can do it, I've had people where they pay themselves back more, but they hold it in a different bucket. Like maybe it's in a bank account outside of the whole infinite banking policy. That's usually in your private lending to yourself.
Okay. Judy VIP is saying, what are your thoughts about a lump sum dump in versus smaller monthly deposits? Is one better than the other?
Depends on what you're working with, what you're trying to do, right? Joe's favorite answer, 2 words, it depends.
Yeah.
So, if you have cash flow and it's sitting somewhere and it's being lazy and you want to put it to work and you have an opportunity to put it to work, then why not put it in a dump in? Why not have it accelerate faster, have higher early cash value, give yourself more death benefit? It gives you a whole bunch of things. Or if you don't, and you're just starting to pay yourself and you want to build it up over time, then do it that way. But everything's better than not doing anything. So either way works.
But also on this one, if the lump sum is a dump in, well, the monthly deposits, is that your premium deposits? Because you have to have a premium no matter what. So there's going to be a premium and a dump in, or just premiums. That's kind of how I'm reading that as well.
Yeah, I was going to bring that up because it's not just a one-time payment. It's not just a lump dump.
Right.
So these policies you still have to pay on and keep depositing your money every year. So that's how it works. Annually or monthly, it doesn't matter, but the deposit's still there and you can put in the dump. And all of that would go to the banking portion because it would be PUA.
So maybe the other way to think about it too is, if you do an annual premium versus a monthly, like there's that as well. And then the other one is if you do a larger monthly and no dump in versus small monthly and a dump in. So there's all different ways. It's just whatever math makes the most sense to your situation.
Yeah.
Well, it depends on how their cash flow is coming.
Yes.
Look at that. All went back to it depends.
Yeah.
Well
But
done,
Look at
guys. Well done. Way to tie it up.
And at least now they know why it depends.
That's teasing because it's fun.
Yeah. We like fun. Keep it coming.
All right, I'm going to read this last question and then I'm going to jump off. So Shell Bell is saying, I've worked with a company that shops funding for new companies, even high-risk companies or higher interest. They're higher interest, of course. I think that's in response to Christian's business question. And then Jeff has a crazy thought. Can I take a loan to pay a loan so I don't have to pay the interest this time around?
But you're still paying the interest.
Yeah.
Yeah. Is that a triple black hole? This actually came up with someone that said, hey, can I borrow from a policy to start another policy? They call that laddering sometimes. I don't think that's this kind of scenario, but it depends on where you're getting the loan from to pay the other loan and what loan you're paying off. There's very rarely is it ever going to make sense to get a loan from an outside institution to pay a policy loan, because policy loans are so much more powerful than an institutional loan. And additionally, the interest on most loans is charged on an annual base or daily basis. So no matter what, there's going to be interest because it doesn't matter when you pay it off. There's the daily balance is a daily balance.
I'm reading that as he wants to take a policy loan to pay the policy loan.
Yeah,
So
that's how I read it too.
pay interest. So you always have to pay the interest, Jeff. And it's not necessary to pay back the loan if you don't have the money to pay back the loan. That's why you're in control. You pay back the loan when you have extra payments.
And
But
just
the interest-
remember, when you take that loan, you're increasing your loan balance again.
Mm-hmm.
Yeah, loan is from the policies. What are you saying there? Yeah, I mean, since they don't charge, since you don't have to make a payment on the loan, that wouldn't make any sense because now it's just coming out and then going right back in. It actually literally have zero effect.
Yeah.
So, yeah, interesting thought though. I like it. And then he says here, got it. I thought interest was only at the end of the year. It is, by the way. Well, Depends on what company. One charges interest and then adjusts it. One charges at the end of the year, but it's calculated on a daily balance. So it's not like you can like pay the loan off and there's zero interest. As Joe said, there's a daily accrual of that interest. They just apply it at the end of the year. So the better way to think of this is that if you make a payment on the loan during the middle of the policy year, you're paying the principal down, which means the effective interest rate is going down as well, because you're only paying principal. So that's why these loans are so powerful, is that you can really lower the rate anyway just by paying the loans back. Yeah. All right, guys, get those questions in because we're running out. Otherwise, you're going to hear Joe talk.
We don't want that.
He's going to teach us how to use the computers, by the way.
Oh boy.
There's an on button. I don't know where. No,
We don't have a question. Oh,
yeah.
Do we have one here?
Yeah, there's one here. So Brett says, I'm wondering if there is a loophole. I will give you more info momentarily. He's looking at his policy illustration, and his PUAs essentially ends at year 7. 8+ says I have the maximum allowed premium, which is significant. So wait a second. So is there a loophole? So you're saying that the policy illustration PUAs essentially end at year 7. Year 8+ says I have the maximum allowed premium, which is significant. Brad, we have to see your illustration because typically we don't illustrate the PUAs ending at year 7. What actually ends at year 7 is the term insurance, which lowers the premium. And then PUAs can continue oftentimes 5, 10, 15, 20 years. But we typically show the PUAs dropping off at year 11 just to show you how it can work. But one of the things I always show clients is the maximum you can fund the policy with. And then I show them the PUAs dropping off at year 10 as an option, or year 11, I guess. But I think we have to see the illustration because that doesn't really make sense.
Yeah, the last part's got me confused too, Fouts. So it would be, if they dropped off the PUAs after year 7, they might have done that. I've seen that before, or sometimes you're going to do after year 10. Kids policies might be after year 15, year 20. But just know, no matter what year it is, whether it's year 2, 3, 4, 5, 7, 8, you always have the option. PUAs are optional. The premium deposit, the base, is what has to go in, plus $10 for most companies to keep the PUAs attached. So just know every time you're looking at an illustration, that's just showing you kind of how it was designed and maybe communicated with you, but doesn't mean that's exactly how it works.
Yeah. And one of the things I'm trying to make sure everybody's aware of too is that when we show you an illustration, that's just showing you the options that you could choose to make it look this way, but that's not necessarily how the policy will perform, depending on what you do. It depends on what you do, because as Jason was saying, you have to choose to have the PUAs drop off at year 11. It doesn't happen automatically, even if it's shown in the illustration that way. And with some companies, when the term drops off at year 8, you have to request it to drop off at year 8. Depends on the company, I found out.
I love that you're saying that, Brian, because a lot of this, for anyone that's listening today or is new here, banking is really about what you're doing with the policy. It'll work when you work it. It's that simple. It works when you work it. The more involved you are, the more you understand what's going on. And if you don't get it, just say, I don't get it yet, but just be aware that every year you have these different options. And so really understanding what those options are, what you can do with them. Like if you're someone who's did a large dump in, most likely, depending on your age, you'll be able to convert that term after year 7. So if that term rider runs from, drop it off in year 8, well, then you have to convert it in year 7 or 8, like when you're able to. But if it goes out to year 10, then you have 3 years. So it's really understanding the nuances of the policy. And if you don't get it all now, just change one thing. Where are you saving your money? How are you paying yourself? And then learn these things we're teaching you as you go.
Yeah. And Brett, so I have yours pulled up, by the way. So Brett, you have an interestingly designed policy. So just so everybody knows, so he has a 10K, and Brett, hopefully you don't mind me sharing your numbers here.
Too late.
Well, he did say, let me give the numbers.
Yeah. So it's a 10K premium policy. So it's $10,000 per year premium deposit, of which inside that is base premium, term insurance, and PUA premium. Then he's got the option to put in $65K for the first 7 years. Okay. So what happens in year 8, 9, and 10, Brett, is your premium drops down to $8,100. That's the actual base and PUA premium, because we removed the term premium at year 8. So the term goes away because we don't need that cost anymore to make it perform. So you're actually putting in PUA and base. Then at year 11, it drops down to 5K, which is your base.
Okay, so he's got a 50-50 policy. He's got $2,000 a year of term insurance that lets him put in that $65,000 or not. So this is for Brent, for me, like that's cool that you can do that. Maybe I don't know what you do, your background, like how money flows to you. Like entrepreneurs sometimes want that ability, like, hey, I have big tranches of money that come in and I want to have it go in years 2 and 3 and 4. Like I saw an illustration the other day where year 1 was 65, year 2 was 60, year 3 was 9, year 4 was 35, year 5 was 54, year 6 was like 48. I'm like, what the bleep is this? like how, like, did you really map out every investment you had and it's coming back at this time and this is how it's going to work out? Like that's what I was wondering. And it like shows a 300% return, cash on cash return by year 8. I'm like, of course, because you're dropping in these giant amounts of PUAs into it, but you need the term riders in there. Mm-hmm. And often that term rider has a cost. So you're talking $14,000 that is allowing you to do more banking, but you're basically buying 3 extra seats on a plane, hoping your friends are going to be able to go at the same time you want to go.
Yeah. And the cool thing about Brett's policy here, so everybody knows, is that the structure was built for the first year premium and dumping. And then we built it for the following years and checked to see if it changed the term, which it did not change the term or the structure of the policy.
Oh, that's interesting.
Yeah. That's the way I always do it, by the way. So I want to build it for one dump-in and the premium, and then I add the additional PUA dump-ins years 2 through 7 and see if it changes. Sometimes it does, sometimes it doesn't. On this one, it didn't really change anything. Age has a factor, but actually Brett is he's a builder, so he's a home builder. So he's building a lot of homes, creating a lot of capital and cash flow that he wants to run through the policy as efficiently as possible. So that's why the policy is built that way. So hopefully, Brett, that made sense. Hopefully it made sense. I'm trying to see if he has any comments here. Yeah. So pretty cool policy, the design though. I really like that one. So just so you know, on this kind of a policy, Joe talked about the efficiency points. It's cash on cash positive year 3 if he puts in the full 75, and then the break even point is actually year 4. It's $100 off on year 4.
That's an efficient policy.
Yeah. Yep.
And we're talking efficient policies too. I mean, just a thought I just had. You're always talking about the ability to add more paid up additions in. However that may look, whatever carrier, it's really, are you putting the max amount of paid up additions into the policy? Because that's always, as long as you're standard non-tobacco or better, that's giving you access to 90% of the capital that's going in. It's buying more death benefit. That's why when you have the dividend election, you have the, hey, Carson.
There we go.
And you have the dividend electing buying more paid up additions. So it gives you more death benefit first, high cash value, and more the potential to have more dividends, right? Because that's never guaranteed. But all those things is because you're driving more cash value through the policy. That's why you're getting more efficiency.
Now, one last comment on Brett's illustration here and what he's referring to. So I kind of went back and made sure this is what he's referring to. So in the illustration where it says, that the maximum PUAs allowed per year, in the section it says, 1 through 7 is 68, maximum allowed premium per year, PUA premium after year 8 is $58,000. That's what he's referring to, is it says that I'm allowed to put in a significant amount above and beyond what the illustration actually shows. So anybody want to address that?
Go ahead.
So it depends on how you fund the PUAs in the prior 7 years. If you fully fund the PUAs, you can have the option to put in large amounts of PUAs even beyond year 8. But we have to run the MEC test again. So that's what I've been told by Lafayette, is that even though it says you could do it, it doesn't mean you 100% can, because we don't have that term built in. So we have to run the MEC again. But that's what I've been told. But I've never really gotten a solid answer on that part.
So I came in at an interesting time. What's up, everybody? Happy Wednesday, happy AMA. Sorry for being a little late. I was on a client call with her on Zoom, going through almost the exact same questions you guys are addressing right now. So it might make sense. I actually have literally an illustration showing her what we were going to do with the minimum premiums, the max, and I was showing her the differences. So
We have some questions coming in, but what he's asking is, well, it shows that I can put in after year 8, or after year 7 from year 8, I can put in 58,000 of PUAs, but the term insurance ends at year 7. So can you really put in the PUAs after year 7 if he wants to?
Yeah.
Because
and
because if you try to run the illustration that way, it'll mech the policy. So to me, those are always two very conflicting things in the illustrations.
Yeah, I like it. Well, my scenario is a little bit different than that, but might also provide some context for those who want to better understand policy design and paid up additions. So in terms of, you guys are talking about it though, is you want to max fund your paid up additions every year to really build the cash value and the death benefit and the dividends and the whole system. But you don't have to have a set frequency in which you pay the premiums, I guess is what I'm trying to say. What I mean though, is I'm gonna share my screen and show you. I was just going through this. This individual has a policy with One America, and they were like, hey, I just want to pay $600 a month, but I want the ability to pay more into it every year if I can. And so we said, okay, well, let's set it up at $600 a month. With $600 a month, he'd be paying the base policy, which is just whole life insurance. This is what's buying the death benefit, building.
Are you sharing something right now? Just checking.
It says I am. Am I not?
No, we're not seeing anything.
There you
It
go.
literally said,
There we go.
awesome.
It felt like you were getting into details, so that's why I was just making sure before you went too far.
Yes, no good. Glad you stopped me. So they said, hey, I want to pay $600 a month, but I want the option to put in more. How does that work, and how does it affect my policy? So those of you who might be thinking the same thing, hey, I have extra money throughout the year I can dump into a policy, but like I can't do that every month. How can I build a policy to allow me to do that? And how does it affect the policy over time? And so here's the scenario. The base policy, or just the whole life insurance premium, was at $383 a month, and he wanted $600 a month. So we did another 216 of paid up additions. So $600 a month was going in, a little bit to paid up additions, mostly to the base. And if you were to look at the illustration with just those numbers, you actually wouldn't see a ton of cash value in the first few years because the PUA premium is pretty small compared to the base. But they were wanting to do 600 with the option to put in an additional 10 grand into the policy every year. And so with One America and other companies, you can build a policy with that flexibility to dump more PUAs into the policy every year when you wanted to. And so in this guy's situation, he could dump in another 10 grand a year in PUAs beyond just what he was doing monthly, built into his comfortable premium each month. So he said, hey, every December when I get a distribution from my business, I'll throw an extra 10 grand into this and paid up additions. Now, I won't show you the differences because it's a lot to screen share, but I just want to show you how that policy was designed. And the difference was for him that his cash value, if he was to max fund it every year, which he was planning on doing, versus just paying the minimum $600 a month, the cash value and the death benefit would be dramatically different. By paying in more 10 grand a year extra of paid up additions every single year, his cash value in 10 years would have been $120,000 more, and his death benefit would have been $200,000 more. So just by putting more through his system and one, it provides a way for him to use a policy at a frequency that makes sense for him and his business cash flow. And the more he puts through, the bigger the system gets to go do more and more investing. And you can. So I just took this on a total tangent, took this and took it over. So sorry for this example, but if that all made sense to you guys, or you're curious on how the PUAs affect the policy and the options with that, I guess that's another case study you guys can kind of take advantage of time.
Carson, I wish you were more passionate about this, man. I just wish you had a little bit more passion and excitement and helping people and helping them have that flexibility. But what Carson just said, if you didn't fully get it, is this gentleman, $600 a month is comfortable. That's manageable for him. And the floor was even like the manageable floor, like what he truly has to put in was what? Was it $300 a month or a little bit more?
Yeah,
$380 a month. So less than $400 a month was the manageable floor for him. And you can add an additional 10 grand. Why? And what happens when you add 10 grand? It does three things every single time of paid up additions. It's always gonna, I said this earlier, but just to repeat it, it's gonna buy you more death benefit first because it's life insurance. It's gonna give you high cash value. And typically if you're standard non-tobacco or better, it's gonna give you 90 plus cents of every dollar you're putting in. So if he puts 10 grand in, that's 9,000 new dollars. Right? Like I just had the same exact conversation Carson had with a 58-year-old woman who was just approved where she can put an additional $6 grand a year back in. And if she did, it would take the policy's efficiency from 54% in year one, this very plain, simple policy, to 75%. It would move up the efficiency point by a year and a half just by doing it 1 year. So imagine if she keeps doing that every year, the flexibility it gives her and the additional monies that she can run through the policy, because she has money coming in sporadically, depending on bonuses, depending on how she hits things. So it keeps her from needing to expand her. Because I used to say to everyone, Joe said this, maybe Fouts used to say this. People say, when do I start a new policy? Well, it's a 40-ounce mug. Can you put 50 ounces into it? Right? Or 12-ounce mug. Can I put 16 ounces into it? And if you say yes, I wish I could work with you. I love creativity, but that's too creative. Right. But now we can actually say, yes, if we talk about it up front, if it fits your situation, we can help you build that.
Yeah. And Brett has a follow-up.
And Steve?
Oh, we lost Nagy and Carson. So Brett has a follow-up. He says, looks to me like I can add the cash value of $58K annually years 8+. Well, it shows that, but in reality, what's that?
You got to ask. You have to ask. You have to ask the carrier, because at some point you're going to hit the max.
Well, your term drops off. So, but guess what? Is term insurance renewable? Yes. So if you renewed the term, you could actually keep adding those numbers, but you have to ask, because after year 7, since we dropped the term off, it changes. So if you renewed the term, you could actually keep adding the stuff back on. So that's just kind of some of the things to keep in mind. And then the second part of your comment here brings me back to my question. It looks like the interest paid on my loans will be able to add significant cash value. Well, the interest you pay on your loans does not go to your cash value. It goes to the insurance company, because your loan is part of their overall portfolio of investments. Now, as their investments perform, they pay dividends, which comes back to you in the form of cash value. So that's really what's going on. Interest goes to insurance company. Interest goes to insurance company pays dividends. That's kind of the circle of how I look at it. But good question. All right. Okay. So here we got a question for Joe. About to close on a HELOC, and would it be smart to pay my yearly premium to use my usual monthly payment to add to the Velocity banking to pay off my debts?
It's always smart to, if you can, do an annual deposit instead of a monthly deposit, because every month they'll tack on a user fee. Could be $22, $32.
The ACH transaction fee?
If you're doing, monthly, just like if you were to pay your car insurance. A little. What?
Oh, the ACH transaction fee? Is that
no, every month. Every month there's a payment if you go monthly or if you go annual. Mm-hmm. If you do annual, then there's no monthly fee. But to add to the Velocity banking to pay off my debts. So everything that's coming into the house anyway is going into your HELOC. So once you run the money annually through the policy, you would take it out, put that into the HELOC, because we don't want to pay 8% interest. We only want to pay the difference between your loan and your dividends, which if it's Lafayette and it's a dump and you're doing a HELOC, probably looking at close to a high 6. So 7 would be the interest rate. 6.5 could be coming in as the dividend, or 6. So that's 1% inside the policy when we're paying a straight 8 on the HELOC. So we always would want to run it back into the HELOC to pay the Velocity to the higher interest rate.
Yeah, there you go.
I thought Carson overall was on.
I thought that for a moment too.
Baby in there. I was like, is he dressed up for Halloween already as a scarecrow?
Yeah.
baby in there. You breastfeeding? I know you live in California, so
Yeah.
I got jokes. Sorry, guys. All right.
By the way, Joe's last name is Helock, by the way. Yes.
Stop it.
Kovacevic. So Brett, so by the way, so Brett, we keep coming back to Brett. So Brett's a home builder. So he's actually going to be treating, when he borrows from the policy and lends to himself, he's going to treat himself like he would a traditional bank. So he's going to charge himself the interest like a hard money loan that he would get to go do the home thing. So he's going to take the delta between the policy loan interest rate of maybe, let's say, 6.5% and a hard money loan at maybe 12%. I'm not sure exactly how you're going to do it, Brett. And then he's going to capture that delta in another LLC potentially. And so he's treating every aspect of his business just like he normally would, except he's now in control of a lot of different buckets in that whole transaction, which means he profits more, which is awesome.
Yeah.
So that's what he's got going
And
on.
Brett, if you're using your own money as a bank to buy and rehab big properties, you must be balling, man.
He's a builder.
That's awesome.
Yeah, he's a new home builder, I think.
I'm sure you're crushing it.
Yeah, that's awesome. All right, Adul says, can I open a policy and have my bi-weekly paycheck direct deposited into the policy?
You wouldn't be able to put that much money in it.
Yep.
Yeah.
That's the first part. That's the first part.
For the IRS rules, it states that we can contribute up to a maximum of 25% of our annual income.
Yep. And then also you can't do a bi-weekly premium deposit on a policy. You can do a monthly deposit. So I've got a client doing this exact thing right now. And so what I had them do, or what they optionally can do, is they'll put the money into their main checking account, and then they're going to have an automatic transfer to a separate checking account. They'll do that every 2 weeks, and then the policy will then draw the funds out of that separate account once a month. So it kind of operates the same way. It's just the insurance companies don't do biweekly deposits. So Justin, so does the PUA ever drop off, or will it stay as long as the policy is alive? Joe.
The PUA will always be there if you want to pay it. So when I illustrate it for efficiency, I usually drop it at year 11. But then I'll add on that $120, $10 a month to keep the PUA rider alive in case you do want to keep on adding your PUA to it. So it's the best of both worlds. You can put it in and you can see what it looks like if it's not, and you can do whatever you want. So
now, to further answer the question, Justin, is there a time where you could no longer put in PUAs into a policy? Yes. Company specific, dependent, by the way. So certain companies allow PUAs to go in for a long time. Some actually will cut them off. Lafayette, as an example, sometimes especially on juvenile policies, you can get it from your 17 to 24 if you try to really squeeze it in there. You have to drop the PUAs off, otherwise it does mech the policy. So, but it depends on kind of what you're trying to do. But yeah, as Joe said. All right, what else? Yeah, and then Justin's asking, just so you have the option to put in extra. Yeah, I mean, it fluctuates later on down the road, but just keep in mind that what we illustrate, and I always show you the maximum PUAs for the life of the policy. And depending on how it's built and other factors, it will drop. Like Brett Miller's policy, they have to drop off at some point, even though it says it, because it'll mech if you try to keep putting in more. But yeah, it depends on how you fund it and stuff like that. Let's see here. All right, Adrian says, just jumped on a question. If I have a loan balance of $18,000 on my policy and I now have a little bit of liquid, $6K from some investment distributions, what makes more sense, to put the $6K towards the balance of the loan or to my PUA? Great question.
I guess it depends on what you're trying to do. We're all going to give you a different answer here. I've already heard this one before, a little deja vu.
Yeah.
Except there wasn't a baby in overalls. Last time.
Yeah.
I could go.
I mean, I like the PUAs because that just gives you more cash value to borrow back out again. If the money's out there working for you, and you can put $6K and borrow back out again and put it to work and create more cash flow, that could be a great option. So once again, it just depends. But if you put it back into the loan and are you going to borrow it back out again, well, that's just like not even paying the loan back.
Yeah.
So I'd want to put into the PUAs, have more cash value, which means more dividends, which means more death benefit, which means more and more and more and more down the road.
That's my view too.
I would always say, if you can, fill up the PUA to the limit, and then if there's leftover, pay back the loan.
Yep, there you go.
I feel like if Chris was here, he would say the opposite. He would tell you to pay back the loan, be an honest banker, make up the margin on the little additional that you're saving, right? Because you're bringing, if it was a 6% loan, you're probably bringing it down to actual loan interest paid of less than 3%. So, different ways to look at it.
Yeah. I mean, it just depends on what you're going to do. I mean, just math is math, as I always say. So you could always run that. But yeah.
And there's the tool.
Yeah. I don't see any additional questions right now. So
Jason gets to sing.
Yes.
Yeah.
We're all blessed by his voice. You guys on AMA, you should know he has a beautiful voice. He went on American Idol a few years back too.
Oh, look at this. So Brett just said he had a conversation with his farmer's agent. He has never heard of IBC. That just always blows me away that somebody in the industry has never heard of this. That just doesn't make sense to me.
Chris didn't hear about it for 20 years.
Yeah.
I worked in an insurance company for 30 years. I had never heard of this, and I came on board to prove Chris a scam.
Yeah, but the second part is awesome.
How did that work for you, Tess?
Yeah.
I joined the team. Here I am.
She's still trying to find the scam out.
Yeah.
He's
got a whole notebook on you, Fouts. A whole notebook.
Yeah.
You too, Joe.
What's it? Yeah, of course.
Notebooks on you guys. Just writing it down. Every single thing. She documents everything. Tess does.
I sure do.
So,
I know things.
See?
But I have heard of that book before. The Power of One.
too.
I've heard of it before. I don't think I read it though. But yeah, he says his farmer's guy actually created his own strategy with whole life all on his own. That's crazy. But here's the thing. So farmers insurance can't really do the same thing that we do with mutual insurance companies because they're a public company, but you can still have policies with cash value even with them. But that's interesting. He did it all on his own and then had never heard of this, but essentially did something similar. That's cool. I love it. Yeah. The book Power of One, I think, is where you try to take interest down to 0. I think is what it was about, if I remember correctly. Charmaine says, can we do this for my grandchildren ages 17, 14, and 9 and newborn? Yes.
Just need the parents.
Yeah, the parents have to be involved in the application process because they're minors. But yeah, you can do policies. You can do grandparent policies where the parents don't even have to have coverage to qualify the grandkids. But yeah, we'll put in the chat box here. Actually, Snaggy should do that. Want to put in the mentors link, and then Shane. So yeah, I'm leaving tomorrow morning. Actually, I don't even know why I'm going to even bother going to bed. To be honest, get up at 2 o'clock or 3 o'clock to go to my plane flight.
Where are you going?
I'm going.
Where are you going?
Colorado.
I didn't know you were invited.
Colorado.
Thanks, Steven. I'm actually doing one of the breakout sessions. So, yeah. Anybody else going?
Yep.
Are you doing the breakout session for the new bankers?
It's called Dreamer. So it's people that have been around the campfire but have not started yet.
Okay. Yes. So the new potential bankers.
Yeah. And so, yeah, Tess will love this one from Brett. So he's actually studying for his producer's license because he loves this concept so much. So I love that.
Wow.
Yep. It's awesome. Very cool. But yeah, so the link's in the chat box. If you guys want to schedule a call with one of us, that's our round robin link. Go ahead and grab that. God, I had a question come up, and I can't remember what it was here yesterday. I wanted to ask it here, but now I can't find it. Shoot. Anybody else have any questions that come up in their calls recently?
Yeah, I'm thinking of it.
And?
Got it.
Tess, did you say you had one?
I
I thought you said you had one. I'm trying to think of the questions I've had come up recently. So let's see here. I don't have any right here. Oh no, actually, one of the questions was there's actually we brought it up today in our group call, and it's about a 1035 versus a replacement policy. So if you have like a policy that you don't want, and once again, that's your decision if you want a policy or not that maybe somebody else built. you have options with those existing policies on how to move them over to an infinite banking structure policy. We'll just give you the option. You can make your own decision, but there's things called replacement, which is actually where you surrender the existing policy and it goes away. The cash value comes out, and then the cash value is a dump in on a new policy. That's called a replacement. And there's different reasons why you might do that. And then a 1035, which is where you move the cash value over without any tax consequences. But just so you know that if you do have an existing policy that you're thinking of surrendering or canceling, don't do that until you talk to somebody and understand all the options so that you can make the best decision. I've talked to too many people that have had a whole life or some kind of policy or an IUL, and they canceled it because they didn't like it. And then they had some consequences because they canceled it. They had some options.
It's almost, if you think about a 401k, because everybody has had that around their heads their whole time. If you take a distribution, you're going to be taxed. But if you roll it into another program, so the 1035 is like a roll in, and the other is you're
Right.
cashing it out.
And a lot of the times, like if your cost basis, which is the amount you put into a policy, is more than your cash value, there's no tax consequence because there's no gains.
Right.
But there can still be issues when you cancel it and then surrender it and bring it back out and then move it back over. You just want to be very careful, that kind of stuff. So.
And I think this is a lot better than a 401k.
Not financial advice.
But no financial advice. Yeah. Good thing you're there, Brian.
Yep.
I almost called you
There you
David. I don't know why.
There you go. Brian, David, Jason. So this is for you, Joe. So any lenders in Canada that do all-in-one HELOCs?
I don't know.
Yeah, that's a good question.
What?
I'm
You haven't met him yet, huh?
I'm not in Canada.
Yeah,
I'm pretty close. I mean, I'm 12 minutes away, but
You could swim there.
well, yeah.
Yeah.
Yeah, I'm not sure.
Yeah, I know this question's come up before, and I just don't remember the answer. I thought I'd reached out to somebody. Let me look here real quick. See, I should search my notes.
Isn't it Jason Lowe's team?
They're a different product though. No. They're a different product in Canada. It's depends on what company with, but I just looked it up, and this is the answer I had was a re-advanceable mortgage. They call it something different. But I believe they have something similar. You just did look up. So the companies that I had looked up before for a different client was RBC Homeline Plan. So RBC is the company, CIBC, and Scotiabank. Yeah. So those are the ones that I had looked up before that offer something kind of like that. So it's like what they're doing is like in Canada, from the email I created years ago, they combine a mortgage with a credit line is what they're doing. So it's a combination kind of loan. It's a little bit different. There you go. All right. Nisha says, I have a question. If I borrow $200,000, can I put it into a privatized policy before I deploy the money on the deal? Or if they loan money to my debt fund, can I put that into the term life policy, then deploy?
Creative, very creative. We get this question sometimes. You're awesome for asking. It's you must be scaling and growing a business, which is great. But we want to be very careful with things like that. One, I guarantee you that your note you have with your private investors is not going to let you put their money in a policy in your name. It seems very in the gray area, probably in the red area. And as well, you'd have to then qualify for enough life insurance to put in all of that money into a policy. And if you said, yeah, insurance company, this is all money from other people they've lent me, they're probably not going to let you do that. So you are only insurable for so much. It's really based on you and what your cash on hand is, what your net worth is, what your income is. If you have a fund that also produces income, that income can be included in your total gross income as an individual. But no, you probably shouldn't and can't do what you're asking to do.
Yeah. Also, it's not term insurance, so it's whole life. Just keep that in mind. So whole life is very different than term insurance. Yeah. And by the way, this came up with another client I had yesterday. They wanted to put in $300,000 and wanted that to pay the annual premium, but they didn't want any more annual premiums after year one. They didn't really understand that to do infinite banking, you have to have that foundation of the premium going in on a consistent basis for at least typically 7 years. And they didn't gather that from whatever the research they were doing. So just keep that in mind, that you have two things going on. You have a premium that supports the entire policy. Then you have the dumping on top of that overfunds it. So Christian says that, so my better half getting ready to start a new job, would he be better starting a policy or taking advantage of the match 401k or both?
Here's 4 questions you can ask your better half, Christian.
Yeah.
Does she know how long she's going to live? Because this is something that confuses me. I mean, I'm not that smart, so maybe you guys can explain this to me. But if you have this big pile of money and you're going to live for another how many years? Like, how do you know how much money you need to get to zero to draw that down coming out of the 401k? And then I'd be curious to know, if you had a crystal ball, if you could tell, like, what is the market going to look like when it's retirement time, right? That's question 2. And so hopefully you feel a little uncomfortable because we don't know the answers. Question number 3 is, do you know what the interest is going to be, or the inflation is going to be at that point? Question number 4 will be, are taxes going to be higher or lower?
Lower.
In a 401k, you've literally made an agreement with Uncle Sam, your great partner, that whatever he tells you taxes are the year that you need the money, that's what taxes are going to be. You have no say in it.
Yep. Now, that being said, my wife just got a new job as well, by the way, and she's putting money into a 401k with the match.
Yeah.
Reason why, my wife's uninsurable. So that might make it that could also sway a decision, because if she doesn't have any option putting it anywhere else, doesn't have any option putting it into a policy, what are the other options that she has? So she's never had a 401k before, so she's going to choose to do that. That's up to her. I mean, she knows infinite banking a little bit, but she just doesn't have that option right now on the table to do it on her. So,
and I have heard Chris say too that he would recommend taking up to the 401k match, stopping there, and then putting the rest towards the policy. So like the normal answers, it depends.
Yep.
So when I answer this question, the match, I can't give you free money. So if you were to contribute up to the match to get the match, now you're receiving free money. But now, what are you putting the money into?
Yeah.
If the real reason is only to get the match, that means that the 401k is not to make money, but to preserve the money that's in the 401k. So therefore, that means you can't put it into mutual funds. It can't go into international or small cap. It needs to go into what? Guaranteed, stable, to always grow your money and never lose $1. Because if the real reason for the 401k match was to get the match, you can't lose money. So you have to preserve what you put in.
And there is something too about 401k matches. Most companies have a vesting schedule. So it generally takes at least 5 years before you actually get that match. It sits there in a holding account until you hit your vesting.
Yep. And you'll get a very different answer from a financial advisor too.
There you go. And we don't give financial advice.
You just have experience with all these things.
Yeah.
All right. We got a couple minutes left. So Adrian asks, I have a HELOC in the first position with a 200K balance. I have an investment that will be returned to me of 175K that has never been run through an IBC policy. Should I run it through the HELOC or the policy first?
Well, first of all, as soon as you get it, you're going to put it into the HELOC. First thing. Why? All money that comes into the house goes into the HELOC. Now that you have money, sure, now you can run your money through a policy to protect your wealth, and then make it go back out and make more little green men.
Yep. Let's see here.
When people run money through the policy, you have to think what that does for when you put that into an investment. You're hedging against the investment. In case something goes wrong with that investment, you always have that money in your policy paying you dividends on all the PUA that you just ran through. Mm-hmm. It just makes sense.
Yep. Yeah. And Kristen said, he'd rather see his wife, see if she can get a policy first, put it there. Shane said kind of the same thing. I prefer policy versus other retirement accounts. So there you go.
We're all here because we're looking for uncommon results. Like if you're listening to us right now, you're looking for something that is not the common result. It's not you're hoping and wishing and praying that things are going to work out one day, someday, if you keep doing the same thing. So you're looking for another direction. We've all kind of went down that individual personalized rabbit hole ourselves. See you, Snaggy. And he gave us a peace out. And we're here because we've all went down the rabbit hole. We practice this. We teach this. Has changed our lives enough that you feel the belief from us. Like we all have our personal experiences of why we do this and what it means to us. So
if you want to know exactly what a 401k is, ask yourself, 20 years ago, how many candy bars could you buy for $1? Less than today. So every year, the buying power, the purchase power of the dollar bill declines. 20 years ago, were taxes higher or lower? They were lower than today. Every year, taxes go up. How many years do you have left to put into that 401k? 5, 10, 15, 30? How much will that dollar bill today be in 20 years? What would the purchase power be? A nickel? That 25 cents that you're paying in taxes today on that dollar, what is that going to be when you take that money out? 50 cents? So now you're paying 50 cents on the purchase power of a nickel. Who makes out? Not you.
And if you want to know how a 401k really works or was developed, read the book 401 Chaos.
Yep. Ted Benna, the originator of the 401k, what does he say to use? Not a 401k, but a 501k. But
another
what's a
book
501k?
Another book that's pretty fun to read that got some of my thoughts about 401ks and kind of actually the legalities of the contract and how they wouldn't hold up in a court of civil law is a book called Unshackled. It's another believer in IBC, but he literally goes through all the questions I asked you earlier, the same things Joe just said in a different way, but the same questions. Like if you have a hypothesis and you're a scientist, you don't want many variables if you're trying to prove something. Otherwise, you don't really know what you're testing. Well, if you start asking, what are taxes going to be? What is inflation going to look like? What is the market going to look like? How long am I going to live? All of those things are variables that you have no control over. So what we're telling you is we want something that we control. We want something that has guarantees, and we want to transfer the risk to somebody else. What happened when I would call it the great heist, when 401ks and all these qualified things happened, is all of the risk went from the company to the individual. And literally ever since, you see the stats, 5 out of 100 people retire with financial stability, right? Or security. And that just means they don't have to go back to work. It doesn't mean they're wealthy.
Yeah.
So,
and I love what Joe was saying too, is that, the creator, I'm kind of the guy that created the concept of the 401k.
Yeah, it is busy.
That was interesting. So Ted Bennett actually recommends he actually invests in life insurance, not 401k.
Not the 401k, but the 501k. What is the 501k, Brian?
Life insurance.
A specially designed whole life insurance policy.
Gee, so strange.
That's why we're here.
That's it, Shane. 5%ers here. That's right.
We'll knock out these last 2 questions real quick. So Anna says, do you run the money through the policy when the policy is in early years or when your policy is or when it's inefficient? It doesn't matter, Anna. You run it through there whenever you can. So there is no optimal time per se. It's just whenever you can. It's going to make sense. Early years, later years, mid years. Just whenever you possibly can.
Yeah, to make it more efficient when it's inefficient. It is the first concept of infinite banking is thinking long term. And so you're going to have some inefficiency. And one of the things that we teach, I actually worry about this a lot, that we teach people that, hey, you don't have to have any patience. Yeah. Look how much cash value you can have right away. And you have, the efficiency point in year 2. It doesn't teach them the paying themselves first, to having the patience, to delaying gratification. Some of the things it's really needed to have those really strong money habits, I think. So.
And then Nisha, to answer your question right here, talk to an attorney. That's what you need to do. Talk to an attorney about how you can do that and making sure you're not going against any like FCC or SEC rules or laws. just talk to an SEC, probably an SEC attorney is what you're going to want to talk to about how to do that legally. So that would just be my recommendation.
I could set my lender up and have 200.
Yeah.
Well, we did it. We made it to the end again. 5:33. We started at 4:33. We're ending at 5:33. 60 minutes all. Look at us. 59 minutes and 47 seconds. Fouts.
All righty, everybody. Well, another Ask Me Anything. Appreciate everybody being here. Appreciate all the questions. And then, of course, if there's a link above for the mentors call, so go and grab that. And look forward to talking to you guys on a call and see you in the next Ask Me Anything. Take care, everybody.
See you next time. Have a good one.
Bye-bye.